This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This time, not for just a week, not for just a year, but stories of the arc of capitalism over the first quarter of the 21st century. It's been an especially eventful 25 years, from Y2K to the great financial crisis to the pandemic, giving us a lot to adjust to and learn from, starting with profound changes in the economy. Our colleague Michael McKee starts us with an economic overview.
We are fortunate to be alive at this moment in history.
Unemployment was low, the economy was booming.
Never before has our nation enjoyed at once so much prosperity and social progress with so little internal crisis.
Trees don't grow to the sky, and at some point there would have to be a reckoning.
We are in the midst of a serious financial crisis.
Everybody's house was probably overvalued. Anybody who had a mortgage might have a mortgage problem coming up.
Today does mark the beginning of the end.
By the time we got to the American Recovery Act, it was a question of what would it take to get people spending again and businesses investing again.
The economic recovery appears to be proceeding at a moderate pace, though somewhat more slowly than the committee had expected.
We got to 2015 and you still had problems because we had a manufacturing recession then, brought about by the collapse in oil prices.
The wealth of our middle class has been ripped from their homes and then redistributed all across the world.
A lot of Americans suffered because the factories went away, the businesses went away, and that gave rise to the MAGA movement.
Make America great again.
In 2019, things had started to look better. The unemployment rate was very low, growth was picking up, which is the irony of the pandemic.
Today, I am officially declaring a national emergency.
COVID did shut down the economy, and it shut it down very fast. And we saw that in the largest unemployment rate since the Great Depression.
First is providing checks in pockets and shots in arms.
Inflation started to take hold, and then an inflation psychology started to take hold.
We're very strongly committed to using our tools to get inflation to come down.
It is a situation now where everything seems to combine to make people feel more nervous and more unhappy about their situations.
When it comes to the economy, we always start with the numbers. And for the numbers, we often turn to Torsten Slok, chief economist at Apollo, with the help of people like Harvard's Jason Furman to interpret those numbers for us. The first 25 years of the 21st century have been eventful for a lot of us, but particularly for economists. Looking back at the year 2000 now and where we are today, what's the biggest change or surprise you've seen?
See, the thing I'm most surprised about is that the interest rates are so low, despite the budget deficit and the debt being what, to my 2000 eyes, would have been unimaginably high.
So what accounts for that, do you think? What do you think we got wrong and what we would have anticipated?
Look, in 2000, I was working in the Clinton administration. We balanced the budget 3 years in a row. We were on track to fully pay off all the debt. At the time, I believed in that and thought that was good and important. Turns out, I think we had a lot more room for borrowing than we ever appreciated at that time.
We're certainly spending it when we need to spend it. Are we saving it when we need to save it?
Yeah, look, I think we spent too little in the financial crisis. I think we spent too much in COVID. Those were both hard calls to make in real time. It's a much easier call that we shouldn't be running $2 trillion deficits in a year when the economy's growing perfectly fine.
We have seen a growth in income and wealth inequality. To what extent is that attributable to some of the things we felt we needed to do to stimulate the economy? It tended to go, I think, to the people who had capital and not to people who did not have capital.
I put the last quarter century in context of the last 3 quarter centuries. And if I had to rank them, the best one in terms of inclusive growth, strong economic growth, broadly shared, was 1950 to 1975. The worst was actually 1975 to 2000, where we had much slower economic growth and an enormous widening of just about every way to measure inequality. The story from 2000 to 2025 is a little bit more complicated and nuanced. There were some facets of inequality, like wealth inequality, have risen. Other things like wage inequality has actually been falling for more than a decade now. There's been stronger wage growth for the median household than there was in the 25 years before. And so the story is actually a little bit more positive for the last quarter century than it was in the quarter century before, just not as positive as it should and could have been with the right policies.
Torsten, looking back over the first 25 years of the new century, let's talk about some major themes, one of which is inflation. We thought it was all gone away, and then it came back.
Well, for a very long period, the whole research agenda and also the statements from the Federal Reserve was that inflation was not quite at 2%, it was 1.8, 1.7, and so much time was spent in financial markets thinking about how can we get inflation up by that 0.1, 0.2% more. And obviously that changed dramatically when we found out that inflation was not dead in 2020. So what is a very important feature of what has happened in the last 25 years is that inflation can come back under certain circumstances. And this becomes very important when we look into 2026, namely, are the circumstances still here for inflation potentially to begin to move higher next year?
Which leads us to what were the larger forces that kept inflation down, and have they gone away?
Well, a very important force that was keeping inflation down was globalization. It was the case after China entered the WTO 25 years ago that goods were coming out of China and was holding goods prices down. At the same time, immigration globally also went up. That also meant that the cost of labor and wage inflation was also held down. So those forces were weighing on inflation for literally 2 decades after 2000, because we saw inflation therefore simply not move much away from 2%. COVID, again, has, of course, been moving upward pressure on goods prices. And now more recently, when we've had restrictions on immigration, we've also begun to see more upward pressure on wage inflation. So that's also, therefore, beginning to become an issue looking into next year.
Deglobalization and restriction on immigration could drive wages up. On the other hand, artificial intelligence seems to be on the brink of really making a difference the other way.
That's true. So AI is, of course, also a very important development over the last 25 years. We have certainly seen some very significant technological advances. We've not quite yet seen that show up in wage inflation or even in the unemployment rate. So therefore, there's a lot of discussion about data centers, AI, large language models, voice recognition, etc. But at the end of the day, we're not quite yet seeing the productivity gains in the dramatic way that is holding inflation down.
One of the big developments in the last 25 years has been ways that the U.S. and European economies have diverged. Stephanie Flanders, Bloomberg's head of economics and government, explains just how differently they've developed.
At the beginning of the century, you would have said the big project that the European countries were embarking on was the single currency, and a much broader single currency, a much broader collection of countries joining the euro than had previously been anticipated, and there were lots of risks in that. And we can talk about how they managed that, but I think it's fair to say there ended up being a lot of other things on their plate. And we saw whether it's the financial crisis, we saw COVID, and these were crises that, in different ways, I would say, the European governments did not always respond to well, but they did, you know, as one senior policymaker said, you know, European governments do the right thing when they're all on the window ledge looking down.
The euro was a very big move. It came under a lot of siege over the last 25 years. I mean, certainly, great financial crisis put everything under stress. But then we also had I'll call it the Greek crisis, when there were people literally speculating the euro might not survive.
I would say in the first few years of the euro, there was a kind of false calm and a sense of great, achievement on the part of European leaders that turned out to be also complacency. They were all borrowing at the same rate almost, not taking into account those differences. And ultimately, the imbalances that were caused by that was why you had not just the crisis in Greece, but actually a broader Eurozone crisis. But I would say it's a game of two halves, because the second half, the years since the global financial crisis and the Eurozone crisis, have been, although they were very painful for countries like Portugal, Greece, Spain, Ireland, That period of crisis and adjustment has produced some convergence.
Are you moving toward something beyond convergence, into really coordination on the fiscal side?
Very slowly, David, I would say we are moving in that direction, and we've seen a little bit more flexibility on that front from German governments in the last few years. But boy, that has been a very slow process, and I think it is still an area where the politics has yet to really catch up with the economics.
The history of the EU has been getting bigger for the most part for a good long time, with one notable exception. It got smaller in the first 25 years with Brexit. What has that done to the economy of the UK and of Europe?
The deal the UK actually negotiated with the EU turned out to be actually a lot worse than I think any of us would have reasonably expected. We wouldn't have expected such an extreme version, a hard Brexit, as they call it. That has ended up, I mean, the estimates range from 5 to 7% of GDP hit at a time when, as you know, all European countries, and certainly the UK, have struggled to have very much growth. I would also say it's affected the capacity of the UK to respond and move forward in other areas, because so much effort and political energy was absorbed by that long period after 2016, after the referendum, trying to negotiate and then trying to pass a deal with the EU.
Looking forward to the next 5, 10, 25 years, what's the best case for Europe, if not entirely catching up, getting headed in the right direction in terms of closing the gap with the United States and goodness knows China?
So, I mean, obviously, in recent weeks, we've had talk of, civilization erasure, I think, was in the Trump administration's national security strategy. I think we could probably dodge that, but I do think there's a serious kind of question of governability in some of the core economies. In terms of growth rates, I think your best case is sort of, certainly no more than 1%, probably more in the kind of 0.5% a year range.
Coming up, we turn from the first quarter of the century in economics to the ways in which China has transformed itself and surprised some of us along the way. As we continue our review of the first quarter of the 21st century, we turn to one country that has been a story, well, really many stories, in and of itself. Our colleague Enda Curran takes us through China's remarkable transformation.
China joining the WTO in 2001 was probably one of the most consequential decisions, not just for China's economy, but for the world economy.
The WTO agreement will move China in the right direction.
So companies could shift there and both tap into the Chinese market and, of course, export from China to the rest of the world.
The slowdown is not only in the developed country. It will also become a sharp slowdown in the developing country.
The global financial crisis reverberated all around the world.
China is going forward with a $500 billion stimulus package. It will build schools and subways, power plants and hospitals.
China played a crucial role stepping up, spending that money, generating all of that demand and activity, and in that period, China did become the world's second biggest economy. The Belt and Road positioned China as someone who was willing to invest and a source of new capital at a time when capital was becoming scarcer. They invested into ports, they invested into rail networks, they invested into motorways. Well, China has been a victim of its own economic success in so many ways. As China moved up the value chain, then it became a threat to some of those Western economies that had been doing business with China in the first place.
We've been ripped off by China.
No longer are the doors just open for free two-way trade. China had the virus under control, so they took opportunity and really took a leap in terms of electric vehicles and in lithium batteries in particular. Clearly, that window was when the rest of the world was caught napping. China was doing just fine. It wasn't until later when China started to impose restrictions on its real estate sector and its real estate sector started to slow down that you began to see some of the brakes being hit on China's economy.
The problem being that home buyers are afraid to buy homes, worried about distressed developers not being able to deliver on the homes a year later.
The slump has been going on for several years now, and I think it has taken some of the gloss off of China's economy for the rest of the world.
Afsani Beshlas of Rock Creek and Elizabeth Economy of the Hoover Institution have spent a good part of the last 25 years traveling to the Middle Kingdom and coming back to try to make sense of it for us. They looked back at some of the country's biggest changes and challenges. Elizabeth, you've been going to China for quite a few years now. As we look back over the first 25 years of this century, how has China changed?
The transformation has been extraordinary, of course. I think if you look back to 2000, for example, China was an economy of $1.2 trillion. GDP per capita was around $1,000, and it was making more bicycles than cars. It was very much trying to adapt its domestic politics and economics to the demands of the international community. What we see today is pretty radically different from what we saw in 2000. Its GDP per capita now is $13,000. Of course, it's not making bicycles so much anymore as, the most EVs, electric vehicles in the world, and cutting-edge electric vehicles, largest manufacturer, consumer, and exporter. Today, you have China saying, we're front and center, and we'd like the international community to adapt to us. So what you have is China no longer being a rule taker, but a rule maker.
I know you've just recently been in China. How does it feel on the ground, as it were, over there?
It is a tale of two Chinas in many respects. Driving around in Beijing, there's no traffic. There's a kind of gray pall that seems to have settled over the city. The economic activity is not what you might expect. You don't see cranes dotting, the landscape, a lot of new building and enthusiasm. You don't have the sense of a dynamic economy. But when you meet with Chinese officials and you meet with, Chinese tech leaders, you definitely have a sense of confidence. And, the Chinese officials believe that they have a model that works. And that model is investing in technology. I visited an EV factory where they're producing 300,000 EVs in a year, and they only have 2,100 people on their factory floors. And the factory is spotless. You could eat off the floor. It's extraordinary. And they are very confident. They're confident about their ability to compete with the United States. They're confident that they're on the right trajectory. Again, though, I think for the broader, swath of Chinese people, consumption is not rebounded. They're not feeling it. This is very much an economy of haves and have-nots. And the haves are moving ahead very aggressively.
One of the things we've seen over the last 25 years is a migration, first of all, into the middle class, from the rural into the urban setting. Is that continuing?
I think it's one of the interesting things that we haven't seen the middle class continue to expand. And the Chinese are just beginning to wake up to the fact that artificial intelligence and their move toward robotics, they already have 250,000 robots. I think we have about 10,000, in their factories operating. They're going to put people out of work. And so one of the factories that we visited was an autonomous vehicle factory. And the person who was, taking us on the sort of tour of the factory said that they are now being told by the local government that they're going to need to help find jobs for the people that their autonomous vehicles supplant. At the same time, the local government's not allowing them to charge any more than regular taxi drivers or Didi drivers because they don't want those people to go out of work. So I think they have not figured out how they're going to manage the technological change and the demands for employment.
How much success has China already had in reshaping the international community?
I would say much less than we might anticipate. It doesn't seem as though much of the rest of the world is interested in trading the current international system for a China-led international system. That being said, if you're looking for Chinese technological influence or economic influence globally, certainly the Belt and Road and the Digital Silk Road have been transformative. Look at Huawei, which has 70% of the 4G in Africa. Their satellite system now rivals GPS. So I think they can look at any number of metrics and say, we've had a success. At the same time, of course, there have been protests in virtually every Belt and Road country about how China's done business. Interest and the desire, the willingness to have Chinese investment stems from the fact that they can't get that kind of investment from any other country. So I think, if we were to go in and really be competitive, for example, in Africa, in this idea that we're going to promote our tech stack globally, I think we'd be welcomed.
Do we understand in the West just how far ahead China is getting in some respects in technology and manufacturing?
I think most people think of China as producing consumer goods, their toys, basic goods. And that is the way they started. But today, it's a whole other world. So what is happening is most of us are now reliant on not just their basic ingredients being made, but the new molecules being developed in China. EV cars, let's say. The batteries that they are producing are so far ahead than the ones we're producing. So they are jumping ahead in ways that we did not expect. They might have less power constraints, the way they're building nuclear plants and the way they're using clean energy and renewable energy, the opposite of what we're doing in the US. And that's because the government in China is putting so much capital to work alongside the private sector, something that in the most recent past we're not doing.
What is that enormous move forward for China as an economy, as a government, meant for the people of China?
So if we look at the people of China, when this whole process started 20, 25 years ago, there was hope. They were growing fast, double-digit growth. A lot of opportunities for people to get new jobs, move from agriculture to industry into cities, and get out of that extreme poverty. And right now, what's happening because of the overcapacity, let's say, if you're producing EV cars, you might be getting paid less because they have the overcapacity. You're lucky to have a job. So the situation for the individual may not have got better, but China as a whole continues to do well. I think one thing that I found very interesting is we in the US always say China should start consuming more. And if they consume more, they will export less, we will have less of a problem, and they will deal with their growth with domestic consumption. What is very clear with President Xi, but also really maybe people who came before him, they're not interested in domestic consumption. They're interested in world supremacy, as has become evident. So you need to do the quantum, you need to do the AI, you need to be ahead on robotics, you need to be ahead on producing things so that you control your own destiny, but potentially you control other people's destiny. And I think that's what we've missed, really realizing ourselves here.
How have Chinese relations with the United States and with the West changed over these 25 years?
Obviously, when we had the Nixon and the Kissinger period and the opening up and WTO, it was the West hoping that China would open up to US goods and to a more liberal democratic system. And as one went to China and you would talk to your Chinese counterparts, it was always a very open dialogue. What has been very different the last few years is that China has become more closed. If there's one thing that is changing with the Chinese, because they've always been very careful in how they show their hands to the rest of the world, they are showing more overconfidence than before. The other thing is that if you sit in China today, who would expect that the US would be kneecapping its own universities, its own research, its own biotech, is investing less in technology at scale, is not investing in nuclear power, and is not working with its allies? So in a way, that, if you're sitting in President Xi's seat today, you see a lot of potential for China.
Up next, in the year 2000, we were caught up in a tech bubble. Now there's talk of a different bubble altogether. But in some ways, bubbles were the least of what the markets had to contend with in the last 25 years. The first quarter of the new century brought us a great financial crisis, a global pandemic, and several revolutions in the ways markets coped with it all. Our colleague Romaine Bostick gives us highlights and lowlights.
How do we know when irrational exuberance has unduly escalated asset values?
You had a market that hit a peak in early 2000. It proceeded to drop by about 30% in the span of just a few months.
The big question is hard versus soft landing at this point. My expectation is the fundamentals will probably get worse before they get better.
The bursting of the housing bubble was a little bit less of a panic and more of an orderly exit.
We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed.
Most people began to sell stocks that were directly tied to the housing market, but eventually that began to spread to other areas of the market that had nothing to do with housing or credit.
By far, the most important thing is a program be successful, because if it's not, those that are going to pay the biggest price are some of the ones we all care about the most.
Quantitative easing was the effort by the Fed to stabilize the markets. In fact, it was so ambitious, they actually did it 3 times. Once they ended QE3 back in 2014, they had to restart it a little bit less than a decade later when the COVID pandemic hit.
If the epidemic become pandemic,
global pandemic,
I think there's a panic.
a whole lot of panic.
The COVID pandemic was undoubtedly one of the biggest exogenous shocks for financial markets in modern history. The market, in the span of really about 5.5 weeks, plunged 20 to 30%.
This will deliver urgently needed relief to our nation's families, workers, and businesses.
We saw inflation, headline inflation rates, top 9%, the highest for the modern era.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
Meme stocks. The best way to describe the meme stock boom can probably be summed up in one word: boredom.
All eyes seem to be on GameStop.
GameStop to the moon and back.
Gains in GameStop.
This has now reached levels of insanity here.
You're witnessing the French Revolution of finance.
There is a rebellion aspect to it. There's an anti-establishment aspect to it.
At this point in 2025, the vast majority of activity that we see in U.S. public equity markets are actually driven by individual investors rather than institutional investors. That has a big impact on prices. It has a big impact on valuations.
As we begin the second quarter of the 21st century, we're returning to talk of bubbles. In 2000, it was the tech bubble. Now people are wondering if we could be building an AI bubble. Bridgewater founder Ray Dalio has studied the mechanics of bubbles through the years.
I think you have to relate the markets to the geopolitics, the politics. We have a bubble in 2000. And then 2001, you have the international geopolitical problem in terms of 9/11 and then the war on terrorism. And so we spend about $8 trillion in our wars on terrorism, and we run big budget deficits. And then we come into the period where we get down in 2008, we have the great global financial crisis. And the great global financial crisis is not just a financial crisis, it brings over the wealth gap issue. In other words, Occupy Wall Street. And it also was a shock to the rest of the world. And in 2008, very important, that was the first time interest rates hit zero since 1933. And so what happened for the first time since 1933 is we did quantitative easing. We printed money and we bought bonds. That's a marker. And we start to learn that large budget deficits can be monetized. So we learned about monetization. And from that, then we drive it down to negative interest rates. And of course, through this all period is the digital technology, the development of all the digital technologies. You know, devices like this, think about this. This is the everything object and the communications and so on. Very unexpected in many cases in terms of what the effects would be. And then 2016, the change, the big change in the world order and the big change domestically, the beginning of populism and Donald Trump being elected president. And so we have this greater polarity, left and right, that reflects the wealth gap differences. And then that meant a big change in the relationship with China. In other words, recognizing that there's a great power conflict. And that great power conflict goes from globalization to nationalism and the change in that world order. And of course, at the time, in order to be stimulative, there's the printing of money and buying a lot of debt, which drives interest rates down to be negative in some places, and certainly real interest rates to be negative. And now what that does is it causes the leveraging up of assets. In other words, private equity, the emergence of private markets, venture capital, private equity, all being leveraged up. At that point, we begin to have the tightening. We're beginning to feel that effects, the deterioration of the venture capital market and the private equity market and the fragility associated with that. So now we have an economy where so much of it, since really 2020, large budget deficits and necessarily the monetization of that, large gaps in wealth and values and in populism, a great power conflict. Acts of nature, droughts, floods, and pandemics have been a major force in history, and that certainly was the factor in terms of seeing not only the pandemic, but also climate change and its effects.
Ray, some of the major developments over the last 25 years you referred to, like the Great Financial Crisis, 2008, and the pandemic of 2020, have caused the government, the United States, but also other governments, to play a more active role in the markets. Some people have said they've gone from being a referee to actually being a player in the game. What are the consequences of that for financial markets?
That's always been the case in times of great conflict. If you look at when there's great geopolitical conflict, there becomes the necessity to go from a consumer-based economy to a more directed economy of how do you use the resources. If people just get rich and buy expensive things like expensive handbags and so on, and it's not directed, you're not going to have the country be competitive. In the AI world, you have to build infrastructure. You have to build sources of energy. So it has always been at similar times the bringing in industrial policies, as we call them, in order to create that direction. And so, for example, in AI and related technologies, quantum computing and the like, it's quite typical in history to see what's now happening in terms of the competition, or let's call it the tech war between the United States and China, because the tech war is also related to the military war. Whoever wins is going to win everything.
Ray, what about geography over the last 25 years in terms of financial markets? Where have there been surprises in some regions growing a lot, maybe unexpectedly, or others diminishing? And I think, for example, of the contrast between the Middle East on the one hand, where you've been very active, and Europe.
It has to do with immigration and migration. There's been a dramatic change in the population and the politics of what it means, that it's become even cultural. So I would say, the movements of people, or even the changes in the numbers, that demographics. In other words, Europe, the United States, China, a number of these countries, which generally speaking, what we would think of as the developed world, for the most part, although it includes China, have declining populations. And in the emerging world, the global south as we come, they have growing populations that want to migrate. And that's connected to climate change, because as climate change creates greater heat and so on in these areas, it drives migration. And so as we're looking at the migration and the immigration issues, they become greater issues. I think if you just look at the administration's new report on its strategic objectives and the way it views the world, you can see that there are even cultural issues. In other words, which are the areas that maintain their culture, or do they have migration issues? So these are geopolitical issues that are all connected.
I suspect if we talked to you 25 years ago, you would have predicted China would be a major force. Would you have predicted that the Gulf, Saudi Arabia and the surrounding countries, would become as prominent as they have?
Basically, all you need is three things to happen to have a successful country. First, educate your children well so that they can be productive and earn incomes and that they're civil with each other. And then second, if they come out to a country where people can work well to be productive and that there are financial resources like the capital markets, to be able to be productive and everybody earn. And in other words, the basics: earn more than you spend and have more assets than liabilities. If you're financially sound and productive and civil with each other, that's key. And then stay out of wars. Stay out of internal conflicts, that when you have that internal conflict or an internal war of sorts or an international war, that's a problem. So some of these places, I can see that over maybe now I see it better than I saw maybe 25 years ago.
Coming up, as we draw to the end of the first quarter of the century, in some ways it's all been about tech, one way or the other, from Y2K to .com to AI.
And liftoff.
What did we learn from the innovation and the turbulence? The last 25 years have brought us the smartphone, streaming video, and Elon Musk, not to mention that AI and whatever it has in store. Our colleague Caroline Hyde guides us on our journey in tech.
Y2K, the millennium bug, the accident that never happened. We suddenly had this fear that as the celebration moved from 99 to 00, computer systems wouldn't work, but hundreds of millions of dollars were spent putting plans in place.
There will be some Y2K glitches somewhere.
We went from wired to wireless in many shapes and forms.
The Mac, the iPod, and now the iPhone.
We're able to be connected, we're able to be understanding indeed how to communicate, but also we could then interact with the internet at the same time. 2007, streaming hits the big time with Netflix, offering not just DVDs through the post, but a streaming bundle too.
We can improve our service, offer the best of DVD and the best of online, combine those, and then it's a huge opportunity.
We're seeing an evolution in social media that really dovetailed with the turning of the millennium.
Facebook was born in a specific time and place. A college campus, the web.
Facebook made a significant pivot in 2021.
I am proud to announce that starting today, our company is now Meta.
3, 2, 1.
Elon Musk, who came in with SpaceX, born in 2002, and so swiftly, within 6 years, he had already got a privately owned, privately built spacecraft into orbit. People are now talking about putting data centers into space.
AI.
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 AI. Everyone now remembers the end of 2022, when just very quietly, a not-for-profit OpenAI introduced ChatGPT, and the crowd went wild.
I think it takes like unique human arrogance to believe that AI cannot supersede humans.
And it's now that we're seeing IBM say by 2029 we will have in the hands of corporates a really useful quantum computer that will solve real-world problems.
For more on the evolution of technology over the first quarter of the 21st century, I spoke to former IBM president and CEO Sam Palmisano and MoffettNathanson partner and senior analyst Craig Moffett.
Take us back to 2000.
Yes.
And how the world looked in 2000 and how differently it looks today in technology.
Well, it's incredible. In 2000, at that point in time, I wasn't CEO yet, okay, right? So, and I was running the hardware business at IBM, and that was so it was semiconductors, it was storage, mainframes, PC, and all those sorts of things. And basically, the dominant architecture for development, for research and development, was we called it the Wintel duopoly, Windows plus Intel. They were the dominant for client server, and client server had become the alternative to the mainframe, because you could do a lot of the applications in the client server environment that you didn't have to run this big centralized computing environment. So that was that's the world we lived in.
The internet was just getting started, actually.
The internet started in the late 70s. And people, again, didn't realize what was happening is because it was basically research laboratories passing technical journals to each other in a standard format. That's how it began. But all the things that made it the internet as it is today had to be built up.
What do you see converging right now in tech? For example, AI, what it could make possible in various areas over the next 25 years?
I don't think we have any idea, but I can tell you some of the stuff we're working on. I don't think anyone has. It's just like the early days of the internet. Did anybody think that this would get to where you can't live without your smartphone? No, I was part of the industry. Nobody saw that. I mean, we did see opportunities, but we never thought of Uber or GPS or those kinds of things operating on your phone. And that's, I think, what's going to happen here. There are people I know today that are building, they call companies without any people. We're invested in one that's building an AI bank, a bank without people. I think in other areas, which we've done a lot of work on, like drug discovery, you're just seeing the beginning of that. I think if you can take the very complex cases of disease or drugs and forget these big data centers, connect that with a quantum computer, with the knowledge within the AI systems and the data structures and the volume of that data and all those case histories and things, that could be significant. That could be a significant breakthrough.
When are we going to see quantum computers really be usable, and how transformational could they be?
Where it's a defined space that it's not a general purpose computer. And I think that's where when people are talking about it being ready by 2029, I believe that'll be the use cases at that point in time. It won't be what you can do in a cloud today or what you could run historically in a mainframe, which is large general purpose systems that do all kinds of work, manage all kinds of variables and those sorts of things. It'll be very defined. Now, the benefit of that is you'll have the general purpose systems feed the quantum machine. The quantum machine will do its stuff that it can do very, very well and then pass it back.
A lot of changes in a lot of places, but certainly in the telecommunications area. Give us your perspective about that 25 years. What did it look like in the year 2000?
It's quite interesting if you think back to that period for a number of reasons. One is people talk about it as the bursting of the dot-com bubble. But the bursting of the dot-com bubble in reality wasn't terribly consequential. There wasn't a lot of market cap involved. There weren't all that many jobs involved. The bursting of the telecom bubble was much more significant, and it set in motion things that have lasted and echoed for 25 years. I think you can make a case that the jobs lost and the potential for a really serious recession coming out of the bursting of the telecom bubble was why Alan Greenspan and the Fed cut rates aggressively to forestall a recession that ultimately inflated real estate prices and arguably was one of the main precipitants of the bursting of the housing bubble that created the Great Recession of 2010. On the other hand, it created a tremendous amount of telecom capacity that continues to benefit us to this day. And the connectivity and the cost of connectivity that fell so precipitously because of the overbuilding of the late 1990s had really, really salutary effects for the tech economy for another 2 decades. The obvious question that everybody's struggling with today is, what are the echoes between that period and today's potential bubble in AI? And if the bubble bursts, the most important question is really, will the capacity that's being built, all these data centers, for example, but also the power that supports them and the facilities themselves, will those facilities actually have a long enough useful life to have a benefit even if the bubble bursts? Or are they such short-lived assets that unfortunately it simply brings all the pain of the bursting of a bubble without any of the benefits?
When we think about the so-called bubble in the year 2000, often people are thinking of things like pets.com.
Yeah.
But there was also fiber optic, which got really overbuilt, excess capacity.
Right.
But without that fiber optic cable, would we have many of the services we have today?
No, you're exactly right. It really turned out to be tremendously beneficial to the tech economy. There was a genuine capacity shortage going into the late 1990s. And what happened was Wall Street, in the way that it does, figured the way to solve this problem is to fund new companies and new innovation, new entrants, created this extraordinary overhang of capacity. So there was this massive excess capacity. The marginal costs of any telecom business are essentially zero. And so it didn't take a genius to figure out the debt service from all these new entrants was going to be impossible to satisfy. You were going to have a wave of bankruptcies that would create this enormous crash. We never would have had Netflix without the enormous capacity that had been created in the telecom bubble. And Netflix was able to take advantage of essentially free transport to build a business that today is sort of dominant in the entertainment business.
Well, and streaming is all the rage right now, given even some of the deals we're seeing going on or trying to go on. I remember back in the day, going from twisted pair to coaxial cable seemed like a really big step forward.
Coaxial cable, as you said, really took off as the transmission medium to the home. That lasted for another really 2 decades, and it's only been in the last 5 years that you've seen real pressure on that. Because, and by the way, I would argue we're back in a telecom fiber bubble, this time in FTTH, as it's called, or fiber to the home, overbuilding by not just AT&T and Frontier and Verizon and the big companies, but by a host of privately funded private equity companies are building in markets where the density simply isn't high enough anymore to support the returns. And it looks to us like you're going to have yet another bubble bursting, not anywhere near the size of 1999, but we suspect that bubble will burst.
Looking back, you know what we thought we saw in technology in 2000. 2025, looking out, what do you see?
AI is by far the most important and dramatic technology innovation of our lifetimes. It's not even close. And we're really struggling to figure out what it's going to do to societies. You know, that I hear people say, well, of course, the Industrial Revolution was tremendously beneficial to human productivity and humankind, but we had 200 years to adjust to the Industrial Revolution to figure out what are the right things to teach in colleges or schools at the time, and for society to adjust. This is a revolution that's happening in a decade. We've never seen anything like that. And I think the next 10 years are therefore the hardest to predict of anything I've ever seen in my lifetime. Is just how is society going to respond to what is certainly the case that huge numbers of jobs are going to be replaceable by AI. To try to figure out how will society try to adjust to something this profound that comes this quickly. It is an incredibly difficult question or set of questions to answer.
Next, Ray Dalio takes us through the history of bubbles. As we begin the second quarter of the 21st century, we're returning to talk of bubbles. In 2000, it was the tech bubble. Now people are wondering if we could be building an AI bubble. Bridgewater founder Ray Dalio has studied the mechanics of bubbles through the years.
There are so many bubbles that you could look at. I don't think people understand the mechanics of the bubble. So you can look at that bubble, you can look at many, many other bubbles. Okay, what is a bubble? A bubble occurs when there's an enormous amount of increase in wealth relative to money. It's important to understand the difference between wealth and money. Wealth is easy to create. Like now and in other times, what you do is, let's say you raise $50 million for a billion-dollar company. So you have a unicorn, but you raise just $50 million. Then you're a billionaire, and the company's worth $1 billion, but nobody's really paid anything like that. And so wealth is something that rises, but you haven't materialized the benefit of that. And so in order to spend money, you have to sell wealth. And so what the dynamic of a bubble typically is the need to sell some wealth to get some money. That usually happens when there's a lot of wealth relative to the amount of money, and there's a need, and maybe a tightening of monetary policy. It could be wealth taxes. For example, because of the large gaps in wealth and the ability to become very wealthy without paying any taxes because there's no tax on wealth, if you were to have something like a wealth tax, then you would have to have people who are holding these assets, selling these assets, selling some to pay their tax bill. So when we look at all the bubbles in history, there's plenty of lessons of what the mechanics are for that. There's plenty of lessons in the printing of money and the devaluing of money. I mean, the 2000 lesson is just one of many lessons in where the government needs to spend a lot of money, but where's it going to get the money from? So what happens is there's a supply-demand problem for debt because there's not enough lending to finance the debt. And so the central bank comes in and monetizes that. And there's the effect of monetization. It should not be surprising that that causes inflation. So there are many, many lessons. The relationship between the geopolitical or the political having to do with what wars or even preparations of wars are like. In other words, before the shooting wars, there are economic wars and sanctions. Sanctions have existed throughout history. You know, prior to World War II, it was the same sort of thing. Japan is getting expansionist in Asia, and what the United States does is it embargoes it cuts off their oil, and it cuts off the payments of their debt. So they're holding that. So that's analogous to how China is dealing with the issue. So there are many, many lessons. When we say history rhymes, I mean, it means that in similar circumstances, reactions are similar. Yes, there are many lessons. I think that, that's why I did the studies that I put out as the book, The Changing World Order, which look at these patterns over 500 years, or how countries go broke. There's a mechanics to this that I don't think we learn the lessons. I think we're so focused on the news and the arcs of history because they come far apart. You know, always there's been a breakdown of monetary orders. Always there's been breakdown of political orders or great powers conflicts, but they happen rarely and sometimes happen before our lifetimes, yes. So I think we don't study them.
From your study, the past, of increasing leverage, as you point out, over the last 25 years, there's been a lot of increase in leverage on private balance sheets, but even more, perhaps, on public balance sheets. Is it most likely, given what's happened in the past, that the way to deal with that is basically to print money, discount the value of money, and pay off the debt in cheaper dollars?
That's how they do it. You know, very classically, when the private sector needs money and doesn't produce enough, the government sector comes in and it borrows money and it hands it out in its various forms, and it runs large deficits. And then one man's debts are another man's assets, so they get devalued. So that's been true since 1971 when we shifted to a fiat monetary system. In other words, up until 1971, there was always gold and then the promise to deliver gold. And the way that it worked is they printed up many more promises to deliver gold than there was gold in the bank. And then they had to devalue, break the link, and so on. And then they gave up on that in 1971. And so we have a monetary system. And that's the way it works. Of course, it's easier through the printing of money. Because when you hold a dead asset, you're holding promises of others to give you money. And if there's a tightness, then it's easier to print the money to pay that off. And so that happened 100% of the time.
One of the things that we've seen over the last 25 years you referred to is the growth of private markets, particularly private credit perhaps, has really expanded dramatically. How does that fit with your explanation of the cycles and the forces at play here?
Well, I think it was a wonderful development in that it opened capital markets to private markets and so on. But it produced a lot of the leveraging up because in the private markets, most of the great success largely came during the period of very negative real interest rates or hardly any nominal interest rates, because that was it, leverage long in private markets. And so that's what we're seeing. And now we're seeing the consequences of that now. So you see that as interest rates rose and that leveraging became less profitable, and then those who borrowed have to refinance, you're seeing problems with that refinancing. You're seeing problems in venture capitals. You're seeing problems in the private markets. And you're seeing the lack of exits. You know, in the private markets, generally speaking, there would be a period of time that you would exit through an IPO or maybe an acquisition in one form or another. That's down 60 or 70%. And now a lot of the debt that was required to do that leveraging up is maturing. And that's requiring those entities to then borrow money. So these things go in great cycles, you know? And so I think that that's where we are in private markets. Now the question is, do they make the private markets public markets? Ooh, that's interesting.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.